Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Today we take a look at two stocks in the manufacturing one sector and their 9-month performance for the year 2017. We speak here about Angostura Holdings Limited and One Caribbean Media. Let's take a look firstly at Angostura Holdings, and for the period ended September 2017, Angostura reported earnings per share of just around 36 cents, a 21.7% decline from the 46 cents recorded in the prior comparable period of 2016. Driving a lot of this performance was the revenue decline of around $78 million or 17% from around $458 million in the 9 months of 2016 to just around $380 million in the 9 months of 2017. Gross profits declined by a less than proportionate amount of just around 11.7% from $279 million to just around $246 million. And profit before taxes declined just around 20% from $134 million to $106 million, with profit after tax declining from $94 million to $74 million TT dollars, or just around 21%. So what's the big story with Angostura? Well, revenues remain a big challenge. And as you can see, with one exception being the 9-month period of 2016, there has been a continuous downward trend in total revenues for Angostura. One of the bright spots for Angostura is that in its non-alcohol segment, there has been some growth, just around 20% in total revenues over the last 5 years. However, the alcohol segment, as you can see in red, has been on a relatively continuous decline. What's needed to arrest that decline? Well, the company has embarked on initiatives in the past and continuing initiatives to improve its distribution channels, among other efforts. On a positive note for investors, the company continues to be relatively efficient in its operations, with its gross profit margins steadily increasing from around 58% to just around 65% over comparable periods, and operating margins steady at just around 28 to 30%. Overall, the profit after tax margin has come under some pressure, but has been relatively stable between 20 to 21%. So what's in store for Angostura? Well, the company does have a very valuable asset, that is the Angostura brand. And the Minister of Finance has in previous conversations mentioned that there will be the divestment of Angostura in an effort to recoup some of the proceeds with some of the lending which have been given out to the CL Financial Group. So at a price of just over $15, Angostura is trading at a PE multiple of just around 31 times and offers investors just around a 1.8% trailing dividend yield, one of the lowest in its sector. At this valuation, but based on the valuable asset of the Angostura brand, Bourse maintains its neutral rating on Angostura Holdings Limited. Turning quickly to One Caribbean Media, or OCM, for the 9-month period ended 2017, the company recorded an earnings per share figure of just around 50 cents per share, a 28% or 28.5% decrease from the 70 cents recorded in the prior period of 2016. Now, as we can see, revenues for OCM did not decline as sharply as Angostura, just around a 3% decline from around $340 million to just around $327 million. And gross profits also didn't decline as sharply, just around 2%, from about $127.8 million to $125 million. Profit after taxes did decline measurably for about 20%, from around $48.9 million to just around $39 million. The story for OCM is somewhat different. The profit before taxes and its PBT margin continue to come under considerable pressure, and here we can see by the red line a decline in PBT margin, or profit before tax margin, from around 20% to just around its current level of 17.3%. And of course, we can also see that profit before taxes have fallen from around $80 million in 2013 to just around $56.6 million in the 9-month period for 2017. Now, a lot of competitive pressures and changing dynamics. Of course, the cyclicality in the media industry would have led to some reduced ad spend by companies, which of course is impacting revenues for OCM and other media houses, as well as competition from non-traditional sources of advertising, including social media and other avenues. So at its current price of $14 and with a 30% decline for the year, in terms of its stock price, OCM is trading at a PE multiple of just around 22.6 times and does offer a reasonably healthy 5.43% dividend yield. It should be noted, however, that it's currently paying out more than it's earning to investors in the form of dividends, and persistent and sustained low earnings and decreasing earnings could render this level of dividend payments to investors unsustainable, which means there should be some adjustment, or could be some adjustment, to dividends paid and a commensurate adjustment in valuations. So based on the projected unsustainable dividend yield and the relatively moderate valuations, but a muted economic outlook for most of its operating jurisdictions, Bourse maintains a sell rating on OCM. That's it for this week's edition. For more information, give us a call at 226-8773. Visit our website at bourseinvestment.com or email us at invest@boursefinancial.com. Have yourselves a great investing week. This has been the Bourse Report.